100% μαλακία.
Είναι, παίρνω το post, με συγχωρείτε, είναι 100% μαλακίες.
No, leave. Leave what?
Όχι να φύγω.
Leave what? Teams. No, Mr. Hill. Because I work 12 hours a day.
Kalispera Anthropos, welcome back to O Economica, all about economics and finance. I'm super happy to be here. And so, back again, we have the inflation data. As usual, we are talking a lot about inflation. But, as promised from the other video, we will see this dreadful word, which is inflation, from a different angle. And I'll share with you why inflation is not simply the percentage change of a price. Inflation is a different thing, and it has to do with value of your money, of our money, okay? The value of a euro, of a dollar, of a pound, of an Australian dollar, anything, pesos, any sort of currency. So I think I can say it, so it is basically the purchasing power of a currency. So inflation is not simply the fact that prices go up. The real essence of inflation is that the purchasing power, the intrinsic value of the currency, it has diminished, it has depreciated. Why? Because there is too much currency in circulation. Okay, and then we can see that in the economy, we can create at least 3 different kinds of money. Okay, whether it's money for commodities, whether it's money for fiscal, whether it's money for financial. So we have at least 3 or 4 different kinds of money. Whether you call all of them quids, right? But we have at least, let me take we'll take back our mumbo jumbo here. Yeah, we'll start back from, because I don't need to repeat what we all got from the telly this morning, right? And the other day I say, okay, CPI, it's consensus 2.9. Okay, so it's gone slightly up, but not dramatically. You don't have it was from 2 point something, it's got to 10%. It's a bit of a hump because not all of the things have gone up at the same time, but a few series, like 4 or 6 basket in 12 items, have gone up in price. But as I've been saying up to now, it's not that inflation, our pie, okay, I want to precise, now we will start from here, okay, where we ended the last time. So I want to say a couple of things more. Last time around, okay, I simplified a lot all of this stuff because I'm just sketching, like being on Conduit Street. I want to have a nice cocktail and something. But anyways, so we say that the commercial bank, they give money to the businesses, but commercial banks, they also give money to the consumers, okay? For it's another credit channel that we get, like if we get a credit card or a lease to buy a car or to lease a car or a mortgage, anything, that it's another credit channel that we have between the banks and the retail consumer of bank services. So we're saying that inflation is not simply our pie, okay, and also financial friction. I simplified a lot. Financial friction is not only it's not really the cost of borrowing. Financial friction, technically defined, I had to simplify. I didn't want to be so technical because it's boring sometimes, but it's not boring. It's actually interesting. Financial friction is the inefficiency. So it's like the inefficiency, in other words, is the simple fact that basically when you deposit your money with Lloyds, you get 4% ISA 2 years, and at the end of the 2 years, you find 80 quid in your bank account, and you have forgotten into the bank £1,000. I don't know how much it is. While instead, if you ask for Lloyds to finance buying your car, after 2 years, perhaps you paid a lot more in interest. So the inefficiency between the saving rate that you get and the borrowing rate that the borrowers has to pay is technically defined as financial friction. So the higher is the financial friction, which is a proxy for the marginal the interest rate margin, which is the markup that allows banks to make a profit. So the higher is this financial friction, then the more inefficient can be the credit channel, the lending channel. And in this model, there is also the cost of agency. Okay, whenever you have any business, there's a cost of agency. If you have a bake me cake agency, a bakery, you have a cost of agency, which is like customer turns up, taps in the card, or say, okay, no, card is refused. I don't know, or perhaps you make some sales and the buyer tells you, okay, I pay you 50% now and 50% in a fortnight. So the cost of agency, it's exactly for any business when you're managing your cash flow and you don't get the cash flow all at once. So there is the cost of agency, the cost of managing the business, and it's basically if your counterparty can default, basically like a business goes belly up. So that's the cost of agency that the bank has to factor in. If like I'm bake my cake, nobody buys my cake and say, I have your cake and eat it. I bake my cake, a bigger cake, and somebody and all the rest of people say, okay, you can have and eat it. I'm not gonna buy it from you, and so I go belly up, full belly, but I go belly up. So inflation, our pie, bake me cake. It's not like price now minus the price of at time t minus 1 divided the price at time t minus 1 minus 1. Okay, let's do a simple example. Perhaps it's also wrong. So it's not the rate of change of price with respect to time. Okay, DOP or DOT. What characterizes inflation is exactly how much less it's worth your money. What it means, very, very simple. So if I had to use £1 coin, if I go to, I want to buy a Toblerone. Okay, I want to buy a Toblerone. Okay, Toblerone. Or I want to buy a Kit Kat. I want to buy a Toblerone. Okay, and the Toblerone ones, they were very large. And let's say 10 years ago, I needed one coin, £1 to buy Toblerone. Now, after 10 years, so we have T plus 10, okay, or T of 10, okay? Let's call it, T plus 10, okay? T plus 10, at T plus 10, after 10 years, T plus 10, this is a plus. What happens that I need 1, 2, 3 coin, okay? 3 coin to have the same thing, the same Toblerone. This is actually what actually is inflation. So it's not that the price of the Toblerone has gone up. It's not that P has gone up simply. It's that the amount of physical coin that I need to utilize, okay, the utility that I have to utilize to buy the same stuff, okay, to exchange to have a Toblerone has increased. So it means that the purchasing power of the coin, the value, the intrinsic value of the coin, it has decreased. That's the thing. The purchasing power of the coin in your pocket has decreased. Okay, like this 1 quid, 2 quid, whatsoever. So that's the very important thing that everybody knows, but we often forget it because we go to the supermarket and say, oh, look at these prices. It's not simply the price. The real thing, the problem of affordability, is that I have to fork up more currency to get the same stuff. It's exactly as perceived as I have to spend more and get less. That is actually the affordability, the cost of living. It's better to say affordability, if you can afford to have that stuff, or you need to search in the market for a substitution. So you want to integrate your product with substitution. Okay, instead of having pure dark chocolate, I'll perhaps have the discount chocolate, which is 10% chocolate and 80% cocoa powder and stabilizers, and there is powder milk. And so I am substituting the products that I am exchanging for my currency. Okay, so technically that's how I prefer to think about inflation. I don't think about the price, but the main problem is how much currency I have to fork out to get the same stuff. And if I don't have enough currency, I cannot do fucking square root of nothing. That's the thing. That's why the wage doesn't go far enough. Okay, so that's the first takeaway. So that it's the amount of coins that we need, that from time 0 to time t plus 1, 2, 3, whatsoever, if I had to use 1 coin, then I need to use 3 coins. And then do I have these 3 coins in my pocket, or I need to, at the end of the day, what happens? I need to go to the bank and borrow that money for consumption. That's where the whole economic system screws up. So basically, you live like an American on the credit card constantly, credit, which is hopeful, honestly. So so that's the main thing. We know, you all know that CPI was 2.9 percent, which is somewhat important, but we are still somewhat in the clear with interest rate. And so let's going back to the example of the Toblerone. Okay, I want a Toblerone. Okay, I want a Toblerone. I want a Toblerone. Okay, and think think what happens if this Toblerone inside shoots as some sort of energy, and this box then ends up here. The box of Toblerone ends up here because inside here there is energy, so you have delta of S. There is this space here. Okay, this is how to explain relativity. But anyway, so if the Toblerone is a radiant body, etc., a source of energy. So then what happens? I have a Toblerone, and 10 years ago I could spend £1. Now at time t plus 10, I will let to fork out of pocket £3, £3, right? I need £3 to get the same chocolate, and perhaps the chocolate has become smaller, shrinkflation. So what happens is that these coins here, this pound here, these, they don't have the same value no more. What? Because this one was 1 coin. Now I have to use this 3 coin. So it means that each and every this coin has 1/3 of the purchasing power, or let's call it value. Value. Yeah. It's 1/3 of the value of this one, of 1 unit, of 1 here. Okay. Coin by coin, 1 coin after 10 years is worth 1/3 of what was the value of the pound 10 years ago. So that's very, I think, explicative of what is the thing here. So here comes again into play Big Mama BOE, Big Mama, the old lady, and the commercial banks, let's call it the banks. Because if I am out of pocket, I will go to the banks and say, okay, bake me a cake, I want a coin, I'm short, I have 2 coins, I have £2, I'm short of a pound, give me a pound. But that pound, it's basically what it has, the value of that pound is 1/3 of the original pound of 10 years ago. Okay, but as I was saying before, so we can go to the bank and say, okay, I need money to buy Toblerone, to buy chocolate. And I was saying that we have, although we call everything pound, euro, dollars, pesetas, Zimbabwe dollars, whatsoever, pesos, we have different kinds of money, and it's quite straightforward. So if the nutters in Westminster need money, we have one form of money. Okay, so they give you the bond, they sell the bonds. Nobody wants to make bonds move these days because they are very inflated. They are very devalued. Too much bond selling. Okay, so they're not worth the suspense of something that it's intriguing, or bonds, something that's very rare and unique. Now you have bonds every day like toilet paper. So anyway, so one form of money which is in pound, okay, public spending is fiscal, okay, fiscal stimulus, okay, which is public spending. Another form of money which goes to the bank, it's the private credit channel, okay, and the banks, they issue forms of money. Well, when it comes to the banks, we have to perhaps expand a little bit this concept of money, okay, currency or money. So when it comes to banks, okay, what happens? The Lloyd's, the big four, okay, they have their bank account with Big Mama, okay, and so you have a thing here which is called, let me squiggle out, bank reserves. It's the current account of the bank. What happens is that Lloyd's or NatWest or Barclays bank reserves, they cannot basically run on dry air. So they have a bank account with the old lady in the what's the thing? Wallet or purse, or the old lady. I was blocked in say purse because it sounds like something else. But they have a deposit account with the purse of the old lady, and these are the bank reserves. So the bank reserves, these are another form of money, because the bank reserves, they are like the piggy bank of the bank reserves. They are the reserves of the bank. But the bank reserves, they fulfill another necessity, or more than one necessity, because these are a form of currency which is financial. It's digital and it's financial, and it never touches into the economy. The bank reserves, they are there to basically settle the payments between banks, okay? Between banks and financial institution in general, banks or funds, okay, pension funds, insurance funds, okay, investment funds. So the bank reserves, they play this game basically, okay? So this form of currency is financial market currency, financial pounds or dollars, okay? So we are already at two different type of currency, okay? We have financial currency, okay? Sorry about that if I'm squiggling, zooming in and out. We have financial currency, which are bank reserves, and this money, it's in the stock market, okay? Then we have fiscal stimulus. Let me do the fiscal stimulus. Let me take a bit of space. Then we have fiscal HM treasury. So we have bonds going here or here, okay? Bonds. So here we have fiscal pounds, okay? And then also we have the consumer, okay? We have the consumer. If I have to buy the Toblerone and I need to study general relativity, I have the money, I have the currency in circulation, I have the pound in circulation, I have the physical notes, so I have the pound in circulation, but you understood what it is, and I have the deposits, okay? This is another kind of money. It's deposits, they are the liability of banks, because you show up at the bank and say, I want to withdraw all of my savings, and the bank clerk asks you why you want to do that. And you can kindly answer, none of your business, give me my money, you must have it, otherwise we are in a bit of a pickle. So we have at least here three forms of money, which are all pound. We have financial money, which are bank reserves, and those are used as a reserve, as a balance sheet account item to show that the bank is solvent. But basically the requirements now are that banks need to have a Tier 1 threshold of above 12%, 14%, but reserves requirements have been perhaps slashed to 0, or cyclical buffer reserves. They don't need to hold so much reserves, okay? They need to show that they have some AAA assets, liquid assets, but anyway, this is technical. We have three kinds of money with the same currency, okay? We have financial bank reserves, and it's basically the bank account that the big banks have with the old lady. So they deposit money to the purse of the old lady. Then we have fiscal money. So it's the money of public spending, okay? Then we have the money of the depositors, okay, which are linked to the banks, and they are deposit, and there is the currency in circulation, okay, which is this one, currency in circulation, which is the physical notes that the Bank of England prints, okay, with I don't know who is the business, but they, of course, the cost of printing the money, although it's plastic and it's more technological, it's way less than the profit that they make by selling the money, okay? So we have at least three forms of money, okay? They can become four when the banks give credit, okay? So basically, to have more money supply, okay, to have more, I want more money, to have more money supply, you need to show up an IOU, okay, and say, okay, you need to create a piece of paper which is called a bond, okay, you need to create an IOU, or a bond, some sort of bond, and the bond goes to the bank, and the bank gives you money, okay, sort of. So basically, what I'm trying to say is that in the system that we have, we need to issue that instrument to have more money supply. Okay, money supply, it's like from M0, M1 up to M4, the aggregate of all, everything can be financial assets, so forth and so on, not only bank accounts, etc., etc. So why it's important to make all these things? Because with the money supply, okay, if the money, we saw that if I have to buy a piece of chocolate and I need £1, and then to have the same piece of chocolate, I need to use three coins of £1. Why this happens? Because when we expand the money supply, okay, the value of the currency, the purchasing power parity or the purchasing power of the currency diminish. It loses value, it depreciates in itself within the same economy, okay, within the same circular thing, okay, within the island of Britain, okay, or within the Eurozone or within the United States. When we create more money, the intrinsic value of those money, it's less and less. So we need to use more of the currency to buy stuff. We need to use more of the currency to exchange the currency to buy other commodities. And that form of money, it's a money that it's a commodities money. Money that it's created for bank reserves and then goes into the stock market, it's speculative money. It's money for speculation. So the real problem that we have is that we create shitloads of money supply, which is directed for speculation. And so we have an inflated money supply, which we don't have any control of, which is basically used for acquiring financial assets, and in the worst of cases is used for speculation and gambling, like Wall Street Casino, and I want 1,000 share of Nvidia, and I want 1,000 share of, I don't know, Bake Me a Cake or Arrow Time, like that sort of stuff. I want Arrow Time. Yeah. So that's why the problem is that we have too much money supply. The intrinsic, the real value of the currency, it's less and less worthy, and so we need to exchange more physical currency or more digital currency for commodities that we need, the basic staples: toothpaste, shampoo, cakes, toilet papers, beer, I don't know, anything, like ticket theaters, and you have a dump just in the corner of the theater somewhere, nobody sees it, don't worry. That sort of thing. So you have to pay more to have a dump in a theater, because it's the new fashion, sort of. So that's from where these three or four methods, which are all the same. So creating a credit instrument to ask to then allow the money supply to increase, to inflate. Okay, the more we inflate the money supply, the more prices will go up, because the value of the money will go down. So that's the big main principle I always stick to. Okay, I keep in mind. Okay, what the money supply is doing, because if the money supply starts, if the money supply, okay, I'll finish this thought. If the money supply starts to decrease, we go into crisis, because we have this hamster wheel that we have the hamster wheel of basically issuing debt and creating money. So I issue debt to pay money, I issue debt to pay money. In the exact moment we stop issuing debt, we stop doing that to create money, there will be no money left to pay the debt that you made before. So it's a vicious circle. You can call it capitalism, you can call it, it has nothing to do with liberalism, because liberalism, it's a philosophy. You need to read Montesquieu or other stuff like that. But the system of fiat currency, or I don't know, I don't have a precise definition. Okay, this system that we have, it requires the inflating the money supply to grow all of the time, and so we are stuck. And the problem is not that we are stuck. We can cope well with this. I wish to have loads of money. I want to buy me an Aston Martin, and I go dining and lobster burgers, and I order champagne, and I don't know, I pay for pimps. Or I don't do nothing. I have loads of money and I have frugal life. It doesn't matter. It's not the question of money. It's the question that, as I said, the system is we know that the system is inherently unstable. So we go boom and bust, boom and, like a Toblerone, peak and trough, boom and bust, boom and bust. But to come out, to recover from the crash in prices, because at the end of the day, what happens when the stock market crash, it's a collapse in the price of stocks. It all goes back to prices. Okay, so it's very evident, it's a self-evident truth, okay, that when we inflate the money supply, we have a pie of the money supply here, and we grow the pie, okay, and we use this for stocks, okay, the stock price, okay, goes up, okay, but then when stock price goes down, the pie it's smaller, and then we are left with a shitload of debt for which we don't have the money to pay. So apart from that is that basically when we inflate the money supply, what goes up is the price of the stocks and shares in the stock market, okay, so it's always the price of something that inflates, okay, and that's the well-known mechanism we all play with, okay, and so the stock market crash is when the price of stocks lose value, decreases, crashes by 30, 40, 50, 70, 80%. You have a discounting of the stock price that is worth zero, yeah, and so that's the problem. That's the instability of these arrangements that we have, which are philosophically meaningless, because in the end it's meaningless. So having said that we have to clear our minds that we have at least 3 or 4 different kinds of money, and so that money supply can be inflated, and that's the primary source of why we have the delta of P, the rate of change of price with respect to time, okay, and so prices go up, everything is inflating, prices go down, everything is deflating, and the money supply basically it's burned, it's eliminated from the system, because money supply from currency becomes financial assets, and then when those financial assets that are worth 1,000, then their value it's 800, 500, I don't know, it's 50% less. Or you buy a house, you pay 800,000 pounds to buy a house, and then at the end of the day the value of the house is 400, it's 50% less. You have destroyed the money supply because you have transformed the money supply into another asset. You have not exchanged the money supply for commodities, for goods, but you have exchanged the money supply for a financial assets or a financial security, and then the value of that asset it's 50% less, but the house still is the house, whether it has a price tag of 800k or 400k. Your whatever you spend, the money supply that is gone in there is forgone. It's a sunk cost, and it's gone. Basically, it sits into the bank account of somebody else, but then it's gone in circle into the economy, many other things, so forth and so on. And yeah, so because inflation or the rate of change of price, it's most of the time it's positive. So we see that prices tend always to go up and never to go down. We never get like a discount or give me a favor or something, make me pay a little bit less, or okay. You always tend to be charged more of what we expect to pay. Okay, you go to the laundromat or to the clothing. I don't know I don't remember now the exact name, but the laundry. Okay, the laundry shop, or you go to the clothing cleaning shop, and you give them your suit or your Saturday night dress, and or your wedding dress, that sort of stuff, and you want that to be washed and made as new, ironed, and then maybe done some tailoring or some adjustments with garments and things. And then comes up a bill and say, oh, it's 200 quid, because I say, wow, this is my wedding dress from 30 years ago, and now I have to pay you pay the repairing services of the cleaning services more than was the price of the dress in the first place. Okay, so you end up paying more what you expect, and so that's you have things more because of the sentimental affection, but never mind. So anyways, because prices tend always to go up, okay, we can forgo also the euro area statistics. We have that inflation is 2.9 and core inflation is 2.5. They're pretty much the same, but you can massage the statistics as you like. So talking about statistics, we can see one thing which is very interesting. Okay, so if you see here, okay, summary of best fitting distribution. When I take the data from the ONS, I ask the bug, this is buggy code. So what kind of statistical distribution is this sample, this data set of prices? So taken 450 data points in this discrete sample distribution, what kind of distribution I have? And you can see here best distribution that fits the data sample. None of these says it's a normal distribution, which has mean the normal distribution is the it's the famous, if that's ring a bell, the ring the bell, mate. What we're talking about is the bell, yeah, your bell end, which you know what I mean, is when the average is 0 and the variance is 1. It's approximately, when n is approximately distributed 0, 1. Okay, so oh my god, this is something else. Never mind. Anyways, it's the bell curve, right? It's the bell curve. Okay, so this is normal. Okay, and the average is 0, okay, and the variance sigma square is 1. So none of these things, none of these balance as a distribution that is normal. What that means is that they all have a shape. They're all pear-shaped, basically. You see that the line goes up. It has like a tail. Okay, it's a dog that wags its tail. The line goes up in the, like, follows, okay, draws with all this value on the bottom here, okay, which are 0, 0, 0, 5, 0, 75, 1, 12, 15, 0.15, etc. So the line follows a increasing values, okay? So it's not stuck at 0. The distribution is a positive, it has a skew that it's positive, and it has fat tails. Fat tails, technically, it's a fatty thing. That means that the shock, the positive shock on that inflation goes, the level of price goes suddenly from 2% to 12%, it's very likely, it's somewhat likely to happen, or it has happened in the history of, in all of these 450 months that I have just thrown into this thing, it has happened more than once that the level of price has jumped somewhat with fat tail. So there is a shock, okay? And so the level of price goes down because we go from £1 to £3 a liter petrol. So that is a fat tail. You basically fact past the post. And so all of these distribution, they are not centered, they're not stuck at 0, and then they don't have much of distance from 0. They have a lot of variability, and this variability, it's all skewed to the positive side. Okay, it goes from 5 to 10, 15, 20, 25, 30% and more. It depends. Energy, food, alcohol, and tobacco, it has like some fat tail 30%. I don't know what kind of values is taken this, but all of this, like if you see core CPIH, we strip out energy and food, which are volatile. It's 0, it's here. 0, it's here. It's in fact, the target mean, okay, it's 2%. If you want to keep the target as what the Bank of England said, we want to keep it symmetric to 2%, okay, not too much far from 2%, whether it's a bit less than 2% or a bit more than 2%. So we have this bell end curve, right? But in truth, in the actual average of core inflation, it's 2.7. Okay, yeah. In all the 450 months, on average, core inflation has always been 2.7%. It's never been 2%. So for the birds, 2%. And then you see all this bell end, it has a long tail that goes way down to 10% and more. So it has happened in the history of collecting data of core inflation. At some months, you have some data points of 10%. Okay, so we like, hell, fuck all the price stability. Yeah, hell with that. And so why this happens? This is a statistical reflection of inflating the money supply, because I need to buy a new house, a new car, I want higher wages, and I don't know, whatever. I need to earn more from my pub, so I need to put up the price of beer and so forth and so on. So it means that the bell end of the statistical distribution of any measure of how prices behave in the economy across time, it has a positive skew and it has fat tail. So it can have jumps of multiple percentage points. Okay. So you see here, T is for T student distribution, or it's a gamma distribution, Laplace distribution, logistic distribution. These are all not normal. It's not normal. Okay, so the cost of living is not normal. Yes, it's true, because statistically, the distribution of prices is not a normal distribution, which averages, it's stuck. The average is 0 or it's 2%. It's not normally distributed, even if we fix 2% as an average level. Nah, forget it. Never existed. It's never been there. It's like arrow time. It's never been there. The money, it's gone. It's gone. Okay. Now, what happens is that if we do another test, It's of course the Hurst coefficient, which is the Hurst coefficient comes from the study of fractals, and the Hurst coefficient is it's a good thing to know exactly when you don't have this bell-end curve. It's not fucking bell-end, it's not fucking normal. This fucking bell-end is not normal. And so you need to know why this bell-end is not normal. So you use the Hurst coefficient to know why this fucking bell curve is not normal. So when the Hurst coefficient is greater than 0.5, it means that the memory of the fat tail, because it's a fatty, it's persistent. So it means that the jump of prices, of how the jump in the data that it's collected with the inflation data, so that inflation jumps from 2 to 4%, it's persistent. It has a memory. This memory of these jumps, because it's fucking bell-end is not normally distributed, it's persistent, and it happens more than it's perceived. And so I was able, or this buggy code was able to identify the total price increases. Okay, so what happens if we take here, okay, inflation, the data that you got this morning, right? Went up on the telling this morning. I say, oh, what are you up to? I don't know, ITV is a lot of bullshit. And say, okay, CPI this morning, not this morning, sorry, the total price increase. Okay, so the cumulative effect of CPI, of inflation across time, starting 1989 up to June 2026, because I have not included this morning data, okay, because Suzanne was not showing the balcony. So you can't see now. You can't see the data. I can't see Suzanne balcony. You can't see the data, right? So the total accumulated price increases for only what is the collection of CPI, Consumer Price Index, across 37 years, it's 183.3%. Now, if we forgo the 0.3% and we do 183 divided 37, we get to 4.95 and many decimals, which is a very funny number because it's 4, 5, 9, etc. It's a sequence that repeats every 4 digits or something like that. It seems to me, or there is some similarity. Yes, it's 9459, 9459, 9459, 9459, and it repeats itself indefinitely. So let's call it 5%. So on average, every year, the total price increases of CPI spread across 37 years, it's 5%, 4.95, okay? Now, if we take core inflation, okay, core CPI, okay, 151 divided 37, it's 4.08, okay? Let's call it 4%, okay? So if I take this, let's do a recap shit. Okay, so CPI, let's call it 4.95. We want to be precise to the decimal. Core, we call it 4%, okay? And core 4%. Then 3 to 7, what is? Okay, housing services, 3 to 7 divided 37, it's 8.84. Okay, so it's spread on 37. It means that on average, the total price increase on the housing services, it has been 8.84%. Okay, now we are at 8.84%. And I can stop here because it's self-evident, okay, that perhaps to be 2%, it should be 37 times 2. I don't know, something like that. Divided 37, maybe we'll get there. I don't know. It's I don't want to do fantasy mathematics, fantasy algebra. But anyway, let's see RPI. What is RPI? 283. Okay. Well, I was saying that 283 divided 37, it's 7.65. Okay, let's forget about this. Okay, 7.65. Okay, RPI, it basically been ripped off in the pockets. Okay, so it's self-evident that the cumulative total price increase, it's not 2% per year, but this is not the average, it's the cumulative effect of the price increase across time. Okay, and we have in the whole model, we have also tried to derive the Hurst coefficient to know how persistently dangerous are these price jumps that happened across time when the ONS has collected the data, and then you go and double check and you see that more than often there are price jumps. Okay, or in the statistical measure. So the Hurst, we have here the Hurst memory. Here I got this data column. So CPI and core CPI and CPI housing services, they have a coefficient of 0.57 or 53, which is greater than 0.5, although it's a small decimal, but the signal, the indicator, is that there is persistency in the fat tail, okay? Here, these measures here, CPIH and core CPIH, it has an Hurst coefficient of 0.60. I have other models where the Hurst coefficient is high. Now, if we see, for example, the total price increase of shop services, RPI shop services, 400%. RPI all services, 442%. And this goes back, and here, CPI annual rate, this is important. CPI annual rate, electricity, gas, and other fuels. Okay, so the total increase of utility bills, 447% divided 37 years, it's an average of total cumulative impact of inflationary cost of electricity, gas, and other fuels on average per year of this 12.8%, which is a misnomer. Price stability, hell no. As a matter of fact, we don't aim at price stability. We cannot give a damn, right? We cannot give damn because we are in Texas, baby. We don't give damn. that's how it works. So, and if you are in Texas, you either drill, baby, drill, or you pay 12.8% increase in electricity, gas, and other fuel. Okay, because this is Texas, baby. And so here, you see the red line is the 12-month average dispersion of the shock origin indicator. Now, bro, like the monthly dispersion, it has crossed to the upside the 12-month average, which means that short-term shocks have in frequency have increased. Okay, and that basically explains the frequency of how prices change more than often. So here, this is the same inflation memory regimes as exponent calculated with a different method and applying it's more or less it's the same method, but we have higher coefficient, yeah, well above the 0.5%. But the chart here, there's different signal, so we can confront. I can confront the two models results. Okay, still downloading. Anyway, but here in plain English is persistent dangerous. Okay, but dangerous, it's a very big word. But okay, if the Hurst memory it's 0.9 or 1, more than 1 is well above 0.5, so it's there are a lot of fat tails. So we can use the conditional volatility to do other things. But anyway, so only with the information that we have from these two things, very, very simple, we are able to link two simple fact of life. So the more we inflate the money supply, the more the distribution of prices is not normally distributed. It's not symmetric or not so far from 2%, okay, rate of increase, but it's a bell-end curve which is not normally distributed, and it's positively skewed, and the prices, they're all jumping up 5, 10, 15% randomly from time to time, but this from time to time happens more often than not. And this more often than not, it has an Hurst coefficient, it has a memory. So down the memory lane, when I am the off-license shopkeeper, I go down the memory lane and say, oh, by this time, that year, I increase prices. Perhaps I'm not bringing in so much bacon as I need to, and so perhaps I need to increase prices again. And so we start all over again with the same mumbo jumbo that we cannot afford to go and buy milk from the off-license, which is very dire. But I hope it's not. I wish it's not the case for anybody. Okay, but what I said in the other video is that the main important thing for having a decent economy and for being happy is that it's important to have the pie or inflation to be stable. So the level of prices to be stable. For the level of prices to be stable, we need to be careful. You need to be careful on how much money you are creating. Okay, so is this the case that we are used to demand a lot of money because we want to buy a lot of goods that we don't produce ourselves? Okay, you go to the bank and you ask for money because you want to buy a key ring thing. Okay, you want to buy a key ring or something that you lock in your keys, and you have this key ring, this bellend, and it's in your pocket, and then you have this nice gadget. Okay, but you don't produce the gadget yourself, you buy it, and to do that you exchange money. Okay, and so that's the thing, we spend money to buy stuff, we don't even make it. And so that's why we produce more money than the total output of what we produce in the economy. And so that is the main reason of why prices go up and don't stop going up. Because there is too much money chasing always the same goods. And if we don't have something, we spend our money and we buy goods from abroad. So we buy stuff from people, and stuff that we don't make, so we buy it from somebody else. Okay, so that doesn't mean that we have to shut down commerce, but there must be a balance, there must be a sort of stability between the money supply and what is the aggregate output that we have in the economy, which is GDP. So in very simple terms, okay, because if I want to buy a Toblerone, where is the Toblerone? I want to buy Toblerone. If I want to buy a piece of chocolate, I want to buy a Toblerone. Okay, I want to buy a Toblerone. I don't produce physically the Toblerone, and so I need to print money. Okay, and I exchange money with the Toblerone. One, it's 1 coin. Then the next time around, I need to pony up 3 coins to have the same piece of chocolate. Now, what happens is that this coin, they are worth 1/3 of this one, each of these coins. How we measure the rate of depreciation of the coin? The rate of depreciation of the coin is GDP, okay, minus money supply. Okay, so when I have the delta y of t, which is y is the output, and then I have m here, okay, so if I have 1.5 minus 6, I end up with minus 6.5, I end up with minus 5. So it means that every year, if the money supply is 6.5% and GDP grows by 1.5% in a year, it means that vis-a-vis the money supply, the same coin has depreciated by minus 5%. That's the simple algebra that uncovers the mechanism of why we feed inflation with printing money and not printing K-rings or stuff like that. Because we don't produce object, we just print money for the commodity of buying stuff that we don't do. We sit on the sofa and we find a spare couple of 20 quid back at the sofa and say, I'm going to splurge at the pub or something like that. I go to Primark. So we buy stuff that's produced in Bangladesh and shipped over into Primark, and we only have the money to buy that stuff. We actually don't do it, right? We try to do it perhaps in Birmingham, and we use some sort of methods which are not the best methods in the world. But anyway, that's the part of going around all this stuff. It's the rate of change of GDP minus the money supply. If the rate of change of delta M, okay, let's call it delta M, okay, let's M money supply, but it's the rate of change, so it's the delta of the money supply. So if GDP is 1.5 minus 6.5%, which is the growth of the money supply in a year, I end up with minus 5. That is exactly the rate at which the currency is depreciating. And that's very, very important, because this goes back to the business of the banks. The banks make money when they give credit. And the banks make money by doing this. So the profit of the bank, okay, equals 1 plus I, the rate of the borrower, okay, plus the lending, okay, times the lending, not plus, okay, so that's the amount, okay. Let's call it pound, the amount that the bank has given credit at time t, okay, minus, okay, 1 plus, and we saw yesterday, IR of the deposit, the current account, the depositors have with the bank, which is the liability of the bank, time the deposit, okay, let's call it D times T, okay, minus the agency cost, which is phi, I don't remember if this is exactly phi or some other Greek letter, omega T, okay, times what? The agency risk, it's a coefficient omega T, times pound of T, which is this pound, is the amount that the bank has given, as lent, as credit, okay? So, this is the business model of selling money for a living, okay? Not selling your body, selling money for a living. And it's the IR of the borrower multiplied the amount that has been lent out minus the interest rate of the saver multiplied the deposit that it's in the bank of the saver minus a small coefficient omega of T multiplied the amount lent, which is the agency cost, the cost of monitoring the credit. Okay, it's your Expedia credit score and all that shit profiling that happens. But to do this business, the bank needs the money supply. That's plain and simple. Needs the money supply. This part of the equation, which goes against GDP growth, basically. Okay, so that's another particular nuance of how do you keep a business cycle or a whole economy in balance. Okay, yes, how you keep a whole economy in balance? It's not that simple and straightforward as anybody can presume. Okay, we all have opinions, but not all opinions are valid. If I have to be a bit nasty here, if you don't know this stuff, I don't know how worth can be your opinion. Not because you need to know this stuff, but if you're not aware of the fact that you need to print money to do business, and if you print money, you are inflating the money supply, and so inflation is a consequence. And the whole thing revolves around this stuff. But if you inflate the money supply, you are going against actually what you actually is your own production of stuff. Okay, and that means that the value of your currency is diminishing, and so you have inflation. So it's not easy to balance this thing. And I have to give credit to the people who are in the current nutters in Westminster, because they don't have the luxury of quantitative easing. Okay, we have to be intellectually honest. I'm not a voter. I don't have a British passport. I don't vote in British elections. And even if I had a British passport, I would not lend my vote to nobody. But to be intellectually honest, we can absolutely state, as a matter of fact, we are in Texas, baby, and there is no QE going on. The only thing that you can do is take the investment and drill, baby, drill. That's the thing that you do. As a matter of fact, you have to be a grown-up man. You need to take your responsibility. This girl is pregnant. You're gonna marry her, right? So you drill, baby, drill. This girl is pregnant, and the kid needs a father. You need to take your responsibility. So, and the girl grows in labor. She's in labor. Yeah. So to be honest, they don't have the luxury of quantitative easing, and the luxury of quantitative easing was for the previous lot. Tories, who need terrorists when you have Tories? The previous lot had the luxury of 10 years of quantitative easing. Quantitative easing is the seniorage of the government. So it's the ability of the government of printing money at cost zero and do all the spending and expanding of whatever they want and taxing back. Because another important thing that you must understand, right? As a matter of fact, that you must understand in the world that we live in, baby, is that the government, when it comes about with the fiscal money, okay, why we have tax? Why we have this perverse incentive, this evil incentive of doing fiscal spending? Because it's really like it's a snake oil public spending. Why? Because when we have this fiscal stimulus, when we delegate the seigniorage of creating money to the government, and we do quantitative easing, we don't allow anything because citizens, they don't vote. There should be a referendum before implementing quantitative easing. That's my humble suggestion, not opinion, suggestion, based on empirical evidence. But anyway, the government never, when it spends money, it spends money always with the objective of recouping that cash flow, that flow of money. The objective, the stated objective, the policy of the business, of the firm, is that we pay subsidies with the objective of recovering those money. And how the government can pursue the objective of recovering public spending? With tax. So you can fucking forget about it that the government spends money willy-nilly for nothing. The government, before spending money, is already planning how to tax it. That's the main duty of anybody who lives on the government dough. They need to tax to recover that money. It cannot go lost, forgone somewhere, like the COVID bouncing back billions disappearing in the ether. That is plain sight corruption or bribery. It's bad. Okay, it's stealing public funds. It's misappropriation of public funds, and it's bad. Okay, it's ethically very bad. But anyway, we cannot complain about tax if we ask for public spending, which is not within the remit of spending what it's coming in. Okay, so if we ask the government to tap the credit card, we have to expect that they will tap the credit card already with the plan in the other end. Okay, they will give you with one end and they will take back with the 650 ends, or perhaps the 1,300 ends that are in the House of Commons. The 650 MPs, they're already planning how to take money from you because you ask them to provide something for you. So the government fiscal form of money, it's always issued with already with the stated objective of finding out how to recover that money with tax. So the government never spends money without knowing how to tax it. Okay, so public expenditure always comes with tax attached on it. And it's a pain in the ass. It's a pain in the arse. That's why it's difficult for people to hear, don't allow for public spending, because public spending, it's a form of money that it's taxed. You don't want to be taxed more. You don't want to be taxed down to hell, right? You want to have your money for you. So it's better to develop other form of create money supply, which are business. That's why it's often heard that it's the private sector or it's the human ingenuity of creating a business of bake me a cake or bake me a cookie, and then I go and I print my key chain rings and I sell it in the market. I don't know. I sell toilet towels. I sell thermal bags. I sell I don't know. I sell iPhones or whatever. It's better to exchange good for money than asking for money to the government, because the government will come back to you and say, okay, the money that I gave you, you have to pay some tax. And so business creates wages and creates, at the end of the day, it creates happiness, the joy of life of doing something, proposing a product to the community, to be shared with the community at an affordable price. The more there is activity in producing goods, the more human beings, they activate themselves to create things, they activate their creativity in providing goods and services, the more the economy is thriving, the more people they are happy, they find meaning in life, because it's not only of working for somebody else. Meaning of life, it's know yourself and do what you love doing. Often what you love doing is not your job. So it's very important to understand that business, which is an awful word, or the private sector of the money supply that comes from credit to businesses, to restaurants and theaters, and you go and have a dump in the theater, so forth and so on, is that what makes life worth living? Because you have a purpose in life in doing something. Go in a theater and you have a dump in the theater, fuck off, that's it. But you're happy and you are relieved of the heavy water that you have. And so, sorry if I stressed you about the importance of understanding that if we ask the government and politicians to do something for us, we are fucking up ourselves. We need to be independent and say to the politician, I'm not gonna give a vote to you. You can pack up and go fuck yourself wherever you wanna go in away, like in Pacific Ocean, Vanuatu. You go to the Trobriand Islands and you do some anthropological study, and so you understand about anthropology, so forth and so on. But just leave me alone, okay? Leave me alone, and I'll carry on with my business. It's none of your business. So if you want to say it's none of your fucking business, don't meddle with the public sector. Just stay away from voting or getting involved in these empty boxes, which are political party organization, and then they tell you how to think, what to do, how to live your life, what day of the week, what time, and what position you can have sex with your wife, and which kind, or with your husband, or and in any shape or form. Okay, if this is your wife, with your wife, whatsoever. You understand me? And which position in the Kama Sutra you're allowed to use, and which other not. Okay, because we are at this level of intrusion. You don't want to allow that. You don't want that. You want to be free. You want that your natural rights, your God-given rights, natural rights, are respected and observed. And so I can continue by explaining to you that we have come, because in the people in the UK, they like politics. We have come to the point that you have to demonstrate to the state that you have these natural rights, your civil rights, while instead Montesquieu, those people who treasured freedom, individual freedom, they always started from the point that your natural rights and your civil rights are the boundary that the state must never and can't cross. Never. We have flipped around what you call the social contract. So now you have to justify why you can do this or that, why you can have a shag with your wife or with your husband, which is not the way it has to be. Because the way it is that you have your civil rights, you have your human rights, you have your natural rights, and the state must justify itself if it wants to apply a law that regulates your behavior. That's how the social contract that many people define, which is not the agreement between people. The social contract, it's Jean-Jacques Rousseau, it's another thing. Okay, that's the role of the state or the government. The government must not infringe on what are, you must respect. You must fucking respect me. Okay, you cannot allow yourself of prevaricating and tell me what I have to do. You can't do that. So that's very important, and that's the principle by how I live. It's the government that must justify itself when decides to say to people what they can and they can't do. That's why it's important to have the idea, or to have the principle, that you live for freedom of having a business, having your own business, and doing your own stuff. Now, because these are secular things, also inflation it's a secular thing, and it has many cycles. Cycles in what sense? If we transform, let me do this stupid thing. If basically we have CPI, okay, and we change the percentages, we change it in sine of theta, we have like a 0, 1, etc. We have a periodic function periodic with pi or 2 pi, okay, 2 pi. Bake me cake, bake me 2 pi. Okay, so by doing this, okay, by having a periodic function which is sine or cosine of theta, okay, of an angle, so transforming basically the percentages unit into a periodic function, we are able to understand for how long the business cycle of inflation, it's what is its length. Okay, so we see that the dominant cyclical period for CPI index, it's 18.8 years. RPI all services is 18.8 years. If we have shop services, it's 37.5 years. But if we see, for example, RPI, petrol, oil, fuel, or housing and household expenditure, it's 5.4 years. So we see on a macro level with a different method, okay, seeing not the seasonality, the periodicity, okay, the frequency of this periodical function, okay, we are able to see how long is the cyclicality. So when it's 37 plus 37 years, plus 30 years, you see that these big cyclical cyclical trend in prices, they are structural into the economy. But if we go and consider this, okay, the petrol and oil and fuel, we see that it's a much shorter cycle, 5.4 years, which means that by definition, or by what we see, that oil, petrol, and fuel prices, they change more than often. And so their dominant cyclical period, it has a shorter lifespan. After 5.5 years, you already are in a different cyclicality trend for what is energy prices. And the CPIH here, it's because of these are 2015 base year, right? It has a different cyclicality. CPI index has a cyclicality of 18 years. So every 15, 18 years, we have a change of cyclicality for what is the dominant. But we can have different angles and different bell end curve amplitude, okay? Because this is basically, it's like the Wi-Fi, okay? Yeah, with Wi-Fi, we have signals. The signal, it has the bell end, it can be wider or narrower. So the amplitude of the bell end curve, when it's 0.774 or 75, it means that the max cyclicality it's the full 37.5 years. But you have different amplitudes, which are, if you have an amplitude of 0.31, I have a cyclical trend of CPIH, which is 4.7 years. So these tools are useful for me to understand which kind of cyclical trend it's in inflation. It's in the trend of prices. Now, because we are in an energy shock, we can presume that we are in harmonic 7 or in harmonic 8, where the cyclical trend of inflation, it lasts between 56 to 75 months, okay, between 4, 5, or 6 years, okay, because if you consider that the whole thing started in 2022, okay, with the bell end curve in Eastern Europe. Now, fast forward, we are 2026, so we are already in a 4.7 structural cyclicality, which is linked to energy price shock, okay, and other items. So we can expect that this business cycle, for what concerns the trend cyclicality, the trend price cyclicality for all the things that we spend on, it's between 4 and 6 years. Okay, so we are in an harmonic 6, 7, or 8. So this kind of amplitude coefficient, okay, which defines the thing. And I can observe it by having the reconstructed series of the, when I have the sequence of the percentage changes, I can ask the buggy code to use a different Fourier transform. Okay, we go into Fourier calculus, which is used for wireless signals, Doppler signals, radar, sonar, all that kind of stuff. It's that. Okay, so we can utilize that method, and we see how we have this wave function, which is a sine or cosine function, and we see time years, we see the cyclicality. Okay, and here we have the cycle forecast. Okay, and so we see here that we are bottoming here, and the next upturn is going to peak between 2027 and 2028, and then it will go down again. So what tells me this thing is that on a rough measure, on a not very precise measure in percentages, and there are things that I am still studying to understand. I'm sorry if I stopped in my flow thought, but basically I'm still studying to understand how I can take the coefficient or the cyclical position. So how I can take the coefficient that comes out from Fourier transform, and I engineer it back into the percentage change. It's a bit out of my knowledge, out of my calculus knowledge. But let's go to the barbecue, to the meat on the bone. Okay, we can do hunky-dory stuff. Okay, and if we stop here, for example, or here, core CPI. Okay, if we want to see what is going to be the trend cyclicality of core CPI, okay, we know that we have this green arrow here. So the latest period, most recent period, has been a trough. So core inflation at 2.5, 2.6%, according to my modeling done with this reconstructing the signal, the macro signal from the historical trend, cyclical trend of inflation, of prices, it means that from the level where the trend is now, it's bottoming, that's bottomed, and it could go up again cyclically as a trend, and then have another peak, and then have another trough. Okay, so this can be a forward-looking tool or signal that explain to me, informs me, I'm really mumbling, that inflation will go up because the cyclicality signal in the inflation trend, it has bottomed. Okay, all these moving around is that because I have here this signal It says, okay, it shows on the chart, green arrow, line goes up. So the cyclicality of CPI, it can be that going forward will be in an uptrend of cyclicality. Okay, so it means that when we transform back into the expectation of inflation expectations, okay, we can expect that cyclically, okay, because of long established business cycle trend, because it's linked to the shorter term cycle of 5.4 years, which is the typical cyclicality of dominant period cyclicality of energy prices, oil, fuel, etc. CPI and other inflation basket can be cyclically going up. Okay, so that's another tool in my toolbox that I can utilize to see forward what other people maybe are not able to see. Or what I'm scrolling now basically is the reconstruction of the Fourier discrete Fourier transform. Okay, and you see here amplitude spectrum. So you have a spectra of amplitudes. The larger is the amplitude, the larger is the longer is the time of years for which is the cyclical trend of that inflation basket for going from peak to trough and then to peak again and trough again. Now you see here in these small charts, you have individual Fourier components. So you have H1, H2, H3. H1 is the bigger bell end curve. So you have many other sinusoidal which are narrower and narrower in the amplitude, and those are the shorter cyclical trend which are linked to what happens in the economy. Okay, so this can be boring. I understand it can be absolutely you can feel absolutely naked and say, what are you fucking talking about? Nothing special. We see here that Fourier forecasts core CPI. And then the only thing that you will understand is that somebody is, oh, the MPs are furious. Okay, just do some Fourier calculus, man. And maybe we will be sharing the same language. Okay, because calculus is a language. It's not like doing 1 + 1. It's a language. Anyways, Fourier forecasts core CPI. And so it shows me, okay, I peak August 2028. I don't know if the peak is August 2028 because I've done the modeling in August 2026. It can well be, okay? I cannot discard this hypothesis. But these charts basically spit out a value, peak value here, 2.5, 2.7 something, which is not the percentage, is the cycle position. We can on a very loose concept associated with the percentage. But the cyclical position is not even radians. It's not the angle, the phase angle. The cyclical position is the coefficient that comes out from the Fourier transform. So I am stuck to the fact that I have the value and I don't know in calculus. I have seen a few formulas, but I don't know how to send it back, to engineer it back to the percentage form. One of the formats that I have is that if I want the CPI percentage, I take, for example, 2.745 plus the average CPI, which is 0.028 times the standard deviation. And so if I sum this with this, I'm sort of able to reconstruct from the cyclical position coefficient at which peak inflation could be. Okay, so if we take 2.745 plus 0.028 times 0.021, okay, well, it's not much more than that. So that's why probably is no, I made a mistake. 2.745 plus 0.028 times 2.1 standard deviation, 2.8. I don't know. Probably I'm more than probably I'm doing wrong the calculation. So let's try 2.75. I'm just playing. Let's use 2.8% multiplied. I don't know. 0.21. Yeah, this could be a sort of interpretation. The peak would be 3.3%. Okay, but it's really it's a number plucked out on fantasy calculus. Okay, so anyways, that is my my athletic question point. But anyway, what we can see graphically is that the current cyclicality of what is going to be the trend of prices, it has actually bottomed because it has bottomed here, and then it has peaked 2022, the aftershock of 2022, you have a peak here between 2023 and 2024, and you had another bottom here between 2025 and 2026, and now it's cycling up again, and it will peak in 2028, and then it will decrease. But the cyclical position after the second peak will be below zero. So after the next peak, it will be, I think it's going to be proper deflationary. Okay, it's not going to be like a trough that we have now that it bottoms at 2.5 and starts to go up again a little bit towards 2.9, 3, 3.5. The next drop, it will be negative. It will be deflationary. Okay, I think, like just observing what is projected to be the cyclical position is going to be below zero, so negative. So potentially is going to be deflationary. Okay, that would be that basically the business cycle, it's probably, there are two chances. One, we have a miracle of total factor productivity, and then inflation goes down. We start to produce shitloads of stuff, so supply goes baboom, goes like we have a boost in supply. By miracle, we start to be so fucking productive that inflation starts to stabilize. And so we have deflationary pressure and inflation stabilizes. And we have a virtuous business cycle. The other flip side of the coin is that basically this bubble in prices and in bad credit pops, and we have a deflationary crash in stock prices, money supply, debt deflation, so forth and so on. That's the takeaway. Housing services are not projected to be below zero, but even CPI, we'll have to wait after 2028, March 2028, for having a trough of deflationary housing, water rates, and fuel. So it's gonna be a little while forward, a not so distant future. But anyway, these are my forecasts of cyclical forecast extrapolated with Fourier transform that we can slowly observe. But all of the main inflation basket that I considered, they are all peaking, having a peak, a second peak in 2028, whether it's first half of 2028 or like right in Q2 of 2028, more or less after the first 3 months of 2028, we will start to see the back of the peak, of the second peak of the inflation trend. CPI services, they are going to have a big other cyclical bump up, cyclical position 3. So it leads me to think, to foresee that services inflation could start to go up again. And that would be good for wages, but not so good for price stability. So there is, with this in mind, with this tool in the toolbox, I can kind of figure out where the direction of monetary policy could be cyclically going, like a mini short-lived sort of what seems business cycle expansion, which is pushed up by investment. It's a bubble in credit creation via prices that are cyclically inflated by money supply and by energy shock. So it's not for good reasons, unfortunately, because it's supply chains and high energy prices. So the whole thing is gonna go, is gonna peak in 2028, basically. And so in the meantime, central banks, they don't know what to do. My idea is that central banks, they should forget about the interest rate, because changing the interest rate, it doesn't fucking have any effect on inflation. Changing interest rate, it's a constraint for employment and for business credit. What central banks should start doing now, it's buying sovereign debt at the current market yield without changing it. Central banks should have the ability of buying sovereign bonds without going to zero, but keeping rates above the rate of inflation. So keeping a positive yield, okay? So having on one side a tightening effect in the cost of credit, but at the same time having a money supply or a controlling effect of the cost of borrowing by buying sovereign bonds, not at zero, but at the market yield. And so you will see that perhaps the business cycle can stabilize a little bit, but by no means it means that there will be no stock market crash. That's so what central banks should start doing now is at least start buying bonds at the market yield now. In order not to slash rate at zero, because all hell, basically, it's because there is a crisis, there is a financial crisis, and you have to use always the same method, rate to zero and quantitative easing. I think that there should be some form of support for government yield curve and buying bonds at the market yield, and then see what happens in the business cycle. Okay, now we go quickly into the Nowcast, because bear with me, bear with. Found the other forecast, Nowcast. Okay, by no means it's super precise, but what we can see here, okay, if baseline scenario, which is $80 Brent, okay, CPI could have been 2.16, but we have to consider that there is an error of minus, okay, so we have negative, we have this kind of error, okay, which could tantamount to 2.7%, okay. What is funny is that the moderate spike, like 20%, like $96 per barrel, is 2.66. This is very similar to the latest data that we have, but because this moderate 20%, $90, $95, or severe, like this is $115, but because this $90, $100 Brent prices persist for all along 2026, and what is more concerning is that fuel prices or diesel prices are going up. We have that the CPI level scenario could have been 3.28%, which where it's going now in basically chart lines. Okay, we have the red line is the core CPI going up to 3.5%, like in 2027, to then basically decrease back down to 3% and slowly converge below 3%, which is more or less in line with also with the Fourier, with the cyclical thing. The more possible is the moderate scenario, like the dashed orange line. So the even core CPI can slowly be between 2.5% and 3%, have a peak in 2027, and then slowly decrease. Like everything is possible. I don't have like a very clear interpretation. Here, what is concerning to me is that these scenarios, like we are already going towards the 3-4% CPI, the 3% CPI, that's for sure. So we are already in the moderate to severe, like moderate to high pass-through effect of oil energy costs on the overall CPI basket. And the same is another kind of CPI, energy, food, alcohol, and tobacco, around 3%. The most severe scenario is that inflation goes back up to 4, which is very, very severe, because we saw that now we have from 2.6 to 2.9. So it's possible that if these high oil prices will be a feature in the coming months, and also in 2027, that means that there is no way that inflation will not be 3% or something, okay? Also, cyclically, we have seen that it can go to 3.5%. And yes, these are basic forecasts that are made by utilizing a sample model that provides the Bank of England has published in its research paper, which is BOE structure forecast analysis, UK inflation and oil shock. Okay, was made by Bruneau and Feifer, Michel Feifer, and it takes these inflation measures. What it does, it inject in the inflation measure a structural shock, which can be supply, demand shock, energy shock, and monetary shock, and then it projects out what are the response function to these shocks, and what happens. Here we have the volatility, the standard deviation in demand shock, how large are you can see here we have very large standard deviation in energy shock, 5 times larger than demand or minus supply. The same is for supply shock, negative supply shock, or supply shock in general terms, very large volatility. And so it provides this, the model provides this forecast, which every color bar, every color identifies whether the forecast is characterized more by a supply, an energy shock, demand shock, according to the color of the bar, basically. That's my level of understanding, but in more granularity, it's a matter of study. And yeah, basically, anyway, utilizing these processes, these models, we get to around, I don't know, 3 maximum 4% scenarios. And yeah, this model is not very well calibrated. And yeah, I think mostly that's all for today. And because we are talking about the Bank of England, I think I have a decent Nowcast. Yes, that's the most decent Nowcast that I can provide. And we have here CPI, Nowcast 3.16. The range is between 3.2, 3.6. And this was starting from 2.6, and the arrow, it's up. So all the baskets that I considered, they have a range, they have a Nowcast of 3%, 3 point something, okay? RPI food, it's probably what is going to be the most benign, the most contained, but RPI all goods can shoot up to go up to 4% as a Nowcast, and RPI petrol there's a Nowcast to 20%. Consider that the RPI retail price petrol, fuel, gas, the last data point was 29% inflation rate for fuel, petrol, oil. So the Nowcast it's decreased to 20%. RPI RPI shock 4.5%, and more or less broader inflation basket going well towards the 3% level, okay? And it's evident by the data that we got in the morning, basically. And that's the most decent Nowcast, the most credible data points or range of data points that I can provide to you, all my wonderful viewers and listeners. And yes, but this happens because there is a lot of, there is money supply. And so I want to show you here, these are data from the Bank of England database, which are publicly available. And the red line, it's the monthly growth rate of net lending to the private sector. So you can see here, the red line is crossed above the net liability. So lending, it's the credit that is created. It's more than the net deposit, the growth, not the amount. The rate of change, the rate of growth of credit created, it's faster, it's 6.7% compared to the rate of growth of bank deposits, which is 5%. Okay, so it means that there is credit created or lent to the private sector. Private sector excluding intermediaries or intermediate OFC. Okay, and I have for sure other things, other charts. This is only one measure. Okay, well, anyway, let's stick with this one with reference to the fact that if we have the level of prices growing up, it's because effectively the rate of growth of credit created, it's higher than the rate of deposit created. I think that, where it is? I have a nice data point because the pace of growth in credit cards, it has increased a lot in the first 6 months of 2026. And this is basically linked to the World Cup. So a lot of people, they have evidently taken out money from the bank to go and see the World Cup. So there has been a lot of credit creation in the first 6 months. It has accelerated. The credit creation has accelerated in the first 6 months of the year. Yeah, net consumer credit. Okay, yeah, we got it here. Okay, you can see here the total change net consumer credit, excluding credit card, and this column here, it's total change credit card lending. Now, if we take this, if we take here January, February, March, April, this first 6 months of 2026, yeah, this first 6 months, and we see the credit creation, the pace of credit creation has been 1 billion, 1.2 billion, 1.2 billion, 1 billion, 1.1 875 million up to June. So these are 6 billion of extra money supply that has been injected on top of this credit card creation, which is another roughly 3 or 4 billion. So we are talking about around 9 to 10 billion pound created. And these are the first 6 months 2026. So these are effectively side effect of the World Cup. People have, the rate of growth has been substantial, 8% per month, 7-8% per month. You can see in the previous month was 6%, then it goes up, kicks up to 7-8% per month. And month total growth rate it's kicked up from 8, 9, 10, 12%. So there is credit creation into the economy, which tantamount to more money chasing the same amount of goods, or we buy goods from abroad, and so prices go up. And that's the dog that wags its tail. So I thank you all so much. I hope you did like the content today, and I'll see you to the next video.
Fuck you.